Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the Fed meeting that happened on Wednesday and what it means for mortgage rates. Logan, welcome to the podcast on this very important day.
Whew! Wow. Okay. That is as good as you can hope for, considering everything that was set up for this Fed meeting and the potential of them doing a similar mistake that they did toward the end of 2023, where they 10-year yield broke that key support line and went up to 8% rates. So, there's a lot of things that happened today, but I would say generally it was positive. It wasn't like the most dovish, we're going to cut rates fast or, anything to support the housing market, but it was good enough for us. And for all of you that read the tracker and follow us all the time, that 4.34 level that we've harped on time after again last year, coming down, now going up. And this is like the sixth time really we've tested this. If that could have broke, man, we would have had some issues. But for now, at least, this has been averted. We'll see what happens tomorrow, but the 10-year yield has bounced off of that level and it's come down. I think the last time I saw this is after the Fed presser is about 4.26. So considering what could have happened, it was a good day.
So we knew, last quarter, so in 2023, we had all hoped that, wow, we might see rate cuts starting, at this meeting, but we've known for a couple months that's not going to happen. So that wasn't what we were looking for. What we were really worried about is could they actually raise rates, or would he come out and have, talk about things in such a way that would just send the bond market soaring? So what did the presser, what did he say in the presser?
So to me, the Fed basically are all in line with 3 rate cuts still. That's still in there. Even with the recent data getting a little bit hotter, they're still down for that 3. Now, I always say that the jobless claims data and the economic data matter more at this point, but 3 rate cuts in. So I think the concern was that, like I've always said, stock traders want to watch the world burn. So there was all this crazy talk that they were going to hike rates and everything. Only one group of people want to see this happen, but in real terms, the hawkish stance could have been, he said, okay, we're now in the 2, maybe 1 rate cut. And, we're really troubled about the recent inflation. Jay just kind of somewhat haphazardly ignored it. They mentioned it, they talked about it, they understand the residual effects, but they kind of said, look, we're just going to, my first tweet was like, they're buying time, right? And that's a good thing because the next few months inflation data should be a little bit different than the first 2. So you got yourself a chance for this to work. The concern is they go really hawkish. The 10-year yield breaks. People saying you need to, destroy the economy. We have to have some more bad stuff happen. There wasn't that take. It was a really, and I think one of the things that Powell said that was very important. He said one of the questions was, what if the labor market is still good? And does that matter about the rate cuts? He's like, no. I mean, listen, the labor market was great last year and the growth rate of inflation fell. And that's one of the things that we always harp on here is that they were thinking they needed the labor market to break for the growth rate of inflation to fall. No, it fell faster than they anticipated. So these are good things. This is one of those Fed meetings where they said a lot of things that were positive. Rates aren't, dropping down in a big fashion or anything, but it could have been worse. And this is one of the things you and I, or you always talk about, what about rates? And I say, Sarah, things could get worse, right? And they got to 8%. And here, that line stuck. So that 4.34% level that could have been a bad day, didn't break. And Powell they raised the growth forecast. They upticked the inflation forecast just a little, but they still got the 3 rate cuts. That means if you see a little bit weakness in the labor data, jobless claims, he finally brought it up today. Finally, the J-Man, after all the times I talk about claims, he said, well, jobless claims went down. That's what we're looking at. It didn't go up. So claims data runs everything. I think the bond market realizes this too. If jobless claims were running at 300,000, then the 10-year yield is going to go down with it. So I'm just happy that that level didn't break, and then we could have been spending the next 6 weeks arguing about, or the Fed arguing what's going on here, and rates go up higher. So I think it's as positive as you could hope for in this situation.
We will take it. I mean, because we have been worried about this for the last week or so, because we did hear different talk about like, oh, now these Fed presidents only want one rate cut, and when would that happen? Whereas, I think the industry is hoping, and maybe the country as a whole is hoping we'll start seeing those rate cuts starting at the next meeting.
Let me tell you, I know it's a positive day when all the stock traders are crying on Twitter about, oh, the Fed is serious about inflation. Boy, it is just beautiful to watch. It's so beautiful. I just sit there. It's almost as beautiful as watching my FICO score charts at these events. But watching stock traders moan and cry, and I'm sitting there like, oh, it's a good day. It's a good day, So again, this had the potential to be bad, but he raised the growth forecast. He raised the inflation forecast. He lowered the unemployment forecast. Let's say from last December, things are a little bit hotter on the inflation side, a little bit better on the economic side, but they kept the 3 cuts. And I think that's, again, cutting, like we've talked about, Sarah, cutting 3 times this year is still restrictive policy. It's not that big of a deal. And I think that's as good as you could have hoped for. Now, we're not out of the woods, because I don't like to be here this high near the technical level. Any 1 or 2 things could send the bond market off. But this had the potential to be one of those days. And we're going into spring, right? And today's purchase application data had a very mild 1% week-to-week decline. But, when rates fall, things get better in that data line. More people buy homes. But, he talked about housing inflation and more on the rent side. And they brought that up about, people were waiting for the disinflation to happen. How about it? In this case, he said, listen, we believe it's going to happen. We're not exactly sure on the timing, but we're very, in a sense, they're very confident that this will take its course too. And since it's so much of the CPI inflation, even though Fed doesn't really track CPI, it's part of the service inflation data that they mined.
So your dad often asks you about like what's going on with the Fed, things like that. He's a loan originator out there. If you're a loan originator right now, what do you think about today? Are rates going up? Or are they going down?
Listen, first of all, if you got a beer next to you, you pop it open and drink it. All right, because I mean, I'm telling you, it could have been worse today. Today could have been straight hawkish. Some of the Fed members could have said, no, we're not down with the 3 rate. I mean, pricing is going to get better on this day as the 10-year yield falls. So it's not a perfect world. We're still dealing with very high rates. But like I talked about last year, things could get worse, and they got worse last year here. And I think a lot of thing is the labor market. I really like the fact that he said, we don't need the labor market to break to cut rates. And that's the right thing to say, because we've talked about that. You don't want to start like cutting rates when the labor market is breaking, right? By the time jobless claims gets to 320, that's not a good thing. You don't want to get to that point. You want to get ahead of the curve out here. So there's some positive in that sense. But the fact that they're all together, and we have time now, we have time for the other inflation data that doesn't have the residual effects of seasonality, maybe come in. And boy, if that rent data starts acting normal again, it's a good sign. And one thing about, as we wrote about in the housing starts data, we saw a big boost in completions, and that's multifamily, right? That's the data line that matters in getting more supply out there. Remember, the best way to deal with inflation is more supply. Now, the odd part is the apartment boom is so over that the permits for 5 units are back exactly at the recession lows during COVID right now. If this continues as it should, we're going to be below the COVID-19 lows. And if it keeps on going, we're actually going to get to the Great Recession lows. Now, normally that's a red flag recessionary indicator, but the charts that we put on in that article, you could kind of see 5 units are going one way, single family units are going the other way. We put the historical going 5 decades, you could see it. They both tend to trend together lower for a recession. but the single family permits are still rising and holding up. Rate buy downs are the big variable there. But and I'll be on CNBC Monday talking about the new home sales report. We'll go into that a little bit more details. So on the inflation front, I'm just curious to think, nobody really asked them because I would have asked them this. Were you a little bit more confident that the housing completion data had a really big 5-unit print? Because again, wages slowing down and more supply, he's correct. That should push down rent inflation data. Again, single family rents are holding up much better. God, you know what I have to do tomorrow morning? I got to get up at 3 a.m. in the morning here to do an NPR interview about this Fed meeting. They're like, oh, you might not want to do this at 6 a.m. our time, East Coast. Oh, 3 a.m. That's kids play. I got to go on CNBC at 2 o'clock in the morning sometime. So, but regards to the inflation data, the fact that completions picked up is a good thing. So it's just I was kind of anticipating kind of the worst case scenario today. So in that light, I'm not disappointed. I'm very happy in this because I stressed to everyone, boy, it could have been worse. And trust, we're just going into spring now. And that's not what you want to see.
So let's talk a little bit about the starts, permits, completions, all of that data that came out. So one of the things that you've been talking about is the line between what happens in multifamily rents and mortgage rates. So maybe you could explain that a little bit right now about like what we saw and why they're connected.
So here's the interesting data line. I can flag you about 27 different economic indicators that show like the economy is moving into the wrong side. And traditionally speaking, with the inverted yield curve and 5-unit permits going to recessionary levels, mortgage rates should be falling soon. Okay, so in that context, that looks correct when we go back all the decades. This is why in that article I wanted to show that chart going back, a few decades. The only variable that's different here is that the single family permits, we call the alligator, mouth opening, the single family permits are still rising. So when we see the full-blown recessionary data lines and housing leads us into recession and jobless claims rise, permits fall for apartments and single family together. There's your first flag right there going into jobless claims rising. And Powell talked about that today, where he said jobless claims is going the other way. He was really saying if jobless claims are rising, we think differently. I'm so glad he said that because I try to convince people jobless claims are running the show right now. And it is too. Like, if for some reason jobless claims started to get worse between now and the next Fed meeting, that's a big deal. But for now, historically, it is true. When permits for apartments fall as much as they have right now, the recession isn't that far off and mortgage rates should fall, but the single family permits are going the other way. And there's why we don't have the job losses that we see in residential construction workers, where we would have seen them already. We have a backlog. Those people got to finish those backlog and the permits are still pushing through. It's a very, very, it is such a historically unique cycle. And everything kind of changed on November 9th, 2022. And that's such an important day. That might even be more important day than the COVID-19 recovery day. But hopefully this can explain why rates are still elevated, even though this is a serious red flag recessionary data line that would force, a more aggressive move lower in the bonding market.
And it's because the builders can buy down the rate for
the builders,
home buyers, right?
So when I go on CNBC on Monday, I'm going to say, listen, advantage, disadvantage. Okay. Sarah Wheeler bought a new home. Okay. Sarah Wheeler got a good rate. So if I'm a builder right now, okay, and I've got this beautiful, nice new house, and you got all these old existing homes. Have you seen some of these existing homes inside? Oh my God, 1960s, 70s. Oh, that carpet. Oh my dear Lord. Whoa. In any case, you're telling, hey, listen, this might be a little bit more expensive, but look, it's a brand new home and we can give you a lower payment. Now, one of the things that I've tried to teach other economists on this topic is that the existing home sale market is massive. Like, it's Shimo, in the Godzilla movie, massive. It's just this giant thing right here. And the new home sales market is tiny, right? It's not that big. But if you can peel off a few buyers from that marketplace, right, it makes a difference here. And when everyone's looking for what's available out there, and remember, the people that are buying homes now with rates this high and prices this high, they're doing well, right? This is not, the struggling class of Americans. They have the ability to buy homes. Imagine someone saying to you, "Hey, I could give you 5.5 here with this brand new home," or you could buy that ugly carpet that looks like it's 1967 in a home that was built in 1925, and that's not, it needs a lot of work. So that's the kind of advantage, disadvantage. They can do this now, right? Because total active inventory is still low, and the builders actually can do something the existing home sales market can't: provide a new product, fresh product, up-to-date product at a lower rate. So they don't have to really do too much to move the needle for them. And this has impacted the housing permits, the single-family permits data, and that's why I really do like showing that chart going back 5 decades. You can see permits, boy, they both move together, single-family and apartments. This time, alligator chart, right? One's going this way, the other one's going this way. And literally, I'm not joking with you, we hit the COVID-19 recession right in between the middle. It wasn't the low point of the COVID-19 recession, but we're right there today with 5-unit permits. That is a major, major recession red flag out there. It's just that the permits data for single families holding up. So the housing market has gone through a lot, man. It is just holding it up. And the residential construction workers haven't been laid off yet. But that labor pool is at risk once those apartments are actually finished, because clearly they're not issuing new permits or anything for new work.
Wow, there is so much going on. That's wild. Well, let's talk about inventory, which is what we usually do on this time of the week, because every week you are tracking that using Altos data. We have updated weekly numbers, and it gives us a clue about what's happening as far as like what's on the market, what the spring might look like. So bring us up to speed on what we saw with inventory this last week.
Sarah Wheeler, are you a mortgage rate lockdown person?
You know I am, Logan. I am. I have debated you on stage for this.
If rates are high, inventory is growing year over year. New listings data is growing year over year. New listings data is back to like 2022, 2021 levels. 2021 levels when mortgage rates were at 3%. Does it seem odd that new listings data is growing when mortgage rates are higher?
No, because as I've told you, it's not that I think there can be no new listings data if mortgage rates are high. It's just that I feel like it depresses it.
So this is a good review for everyone. When I talk about the mortgage rate lockdown isn't a real thing, okay, realize that I've seen the coupon data and I've seen people like sell their 3, 4, 5% mortgages to buy homes all the time. They've been doing this for like 18 months, okay? Then again, on top of that, 40% of homes in America don't have a mortgage. Hard to have a lockdown when you don't have a mortgage. What's occurred is what I've always thought the whole savagely unhealthy housing market is when prices get up so much so fast and rates go up, it can kill demand, but it doesn't necessarily, create an environment where inventory can never grow. What happens is that demand has to stay soft for a period of time to allow inventory to grow, days on markets to grow. It just takes longer to sell a product. What we've seen this year, this is the best part of housing for me, is the active inventory is growing year over year. The new listings data is growing. I've always said this from the start, especially post-COVID, if I can get to 2019 inventory levels, I'm throwing a party because I have a buffer right now. What I always concerned about is even last year, mortgage rates, range between 6 to 8%, but the positive demand curve that we got toward the end of 2022 going into 2023 really shifted the, bottom of the seasonal inventory data all the way to April. We had 5-6% home price growth with record low demand still. That to me is not a healthy housing market. But in this case, the positive data is that inventory is growing. I know Florida and the hurricane area is really leading it, but in general, I don't care. As long as inventory is growing year over year, it's a positive. And that to me is the good story. New listings data is not having a silver tsunami or an Airbnb bust or grandpas and grandmas, leaving whatever nonsense you hear. It looks normal. It's getting back to the low levels that we saw in 2021 and 2022. Positive sign. Inventory is growing. Now, whenever rates fall, demand gets better in purchase application. Whenever rates rise, Demand gets worse. It's been pretty fluid the last kind of 18 months. So today we had purchase application data. We had an increase in mortgage rates. Demand is down 1% week to week. But like we've always focused around this 4 million level. By the time this podcast comes out, the existing home sales report coming out, it might be a beat of estimates just because I think we have some spillover effect. The buyers that are here buying homes aren't as impacted affordability as those that are not in the marketplace. When rates fall, especially if they fall every 1%, that buyer pool comes up, right? So you get more sellers, right? Supply is a function of demand, right? You get another seller coming out there and they're a buyer. It doesn't allow inventory to grow really, but it allows sales to grow. So just remember this, Altos Research, us, HousingWire, the record low active listings was 240,000 in March of 2022. We have double the inventory level, okay, but we have less sales. How is that possible? Right? It's that supply and demand equilibrium. We sell homes faster, things go on a contract, we move things. So this is the question I get a lot. How do we have so many home sales in 2020, 2021 where we got such low demand? Remember, supply. This person knows they can buy a house, so they put their homes on the market, they sell it, they buy another one. That keeps sales rising, but it doesn't necessarily grow the inventory level. So here we are, we're getting a buffer. Embrace it, enjoy it, love it out there. Again, there's going to be a time when rates fall. It doesn't even take much. 6% mortgage rates. Remember our guy Neil Kashkar? That's bad. We can't have 6% mortgage rates. It makes our life difficult. That's 6. Homie did it at 6%. It's one thing if you're at 3 or 4. He came out on TV and said 6% mortgage rate, evil, but it doesn't take much to move the needle if we could go down and imagine a day. I know Powell and President Daly of the San Francisco Fed talked about it. At some point, mortgage rates will normalize. They use the term normalize. If it goes down, demand will pick up. But the construct of the housing market is still somewhat intact. This was the benefit of the qualified mortgage rule, right? You can't have a sales boom anymore in America because of that rule, but it keeps everything in line. It keeps the country in line. It sheds all these homeowners that don't have to move, right? That don't have to buy a house or a new car or whatever. They're shielded by that 30-year mortgage, and we see it because the economy, the U.S., of course, is outperforming the world again. Not a shock. But in this context, it's a positive that inventory is growing. I know it's not a lot, but still, there's going to be a time where rates do actually fall, and they fall with duration. You want a little bit of a buffer this time around, and it is so positive that we are so far away from 240,000. Remember, it's February. It's February in 2022 when I deemed the housing market savagely unhealthy, and it was the worst housing market I've seen post 2010. That was like everyone was buying homes, the prices were escalating. That's not a good thing because eventually you pay the piper on excessive price inflation. And we did, and we're still here with sales low. So the inventory stories are good. Even this year, whenever rates fall, we see demand pick up. We're kind of still around this 4 million level. Imagine one time rates falling. Imagine if the spreads, just the spreads getting better gets us down to 6%. If you get the 10-year yield and spreads working together with all these home buyers that are sitting there waiting, this is not like the credit bust of 2008 where there was underwater mortgages and nobody could buy a home. The credit markets are different. It took a very long time. You don't need Biden's tax credits. You just need lower rates. They're there, right? The people that said housing demand's a mirage, nobody's having kids, whatever, that's Mickey Mouse nonsense. It was there. So I am very, very happy to see the inventory data. And I kind of picked up on this last year when mortgage rates were going to 8%. The new listings data was cool cat, right? Cool, calm cat, and didn't make it leg lower. So the positive story for 2024, at least to me, is the inventory data.
Well, we are gonna end on that very positive note. Number one, inventory double what it was in the low in 2022. And secondly, the Fed did not make things worse today, and we can count on 3 interest rate cuts this
Yeah.
year and no
Yeah,
hawkish
and
talk.
and
So
and again, the key
cuts.
is everyone,
Cuts.
4.34 on that 10-year yield, okay? That's the line in the sand. We want to stay the hell away from that level. We want to keep on getting it, get away from that and get somewhere lower. Between 380 and 4.25, that looks normal to me with the economic data. If jobless claims were getting weaker, then the bond market could head lower with a little bit more duration.
Logan, thanks for being on this important day. Thanks for walking us through it. And we will look forward to talking to you again in a few days.
Pleasure, Sarah.